Okay, good morning, Remisers, trading reps, and clients. Very glad to have you all today for our morning webinar. Let's start off with Valuetronics. So, Valuetronics reported a revenue that's higher 10% year on year. Net profit increased by almost 25% year on year. Okay, so the higher gross profit and net margins was due to a favorable change in the product mix and significant growth in the industrial and commercial segment, which has risen for 5 straight quarters. So operating activities also generated strong cash flows of 303 million, with almost $500 million in net cash on hand at the year end, and this translates to actually 50% of the market cap. The industrial commercial segment delivered record revenues and had a widened customer base as they continue to benefit from the outsourcing trend in manufacturing. Now, Valuetronics has a unique outsourcing ability, which is that rather than just do parts of a product, they can actually do the entire product, whereby the OEM outsources its entire production line to them. This is for the ICE segment, and this is where the focus of their growth is going forward, and which will also deliver better margins. Now, for the consumer electronics segment, there was credible single-digit growth, and this was driven mainly by the LED lamps from Philips Electronics. Okay, so they've announced a dividend policy of between 30 to 50% of net profit, and given that they have such strong operating cash flows and a very strong net cash position, which is ballooning, we certainly see them with the ability to pay higher than 50% in the future. So right now the dividend is 16 Hong Kong cents plus a special of 4 cents, and this equates to about 3.2 Singapore cents. So on the current price of 39 cents, we have a yield of 8.3. Okay, and if they can increase the dividend payout ratio in the future, then I think the stock has a very strong chance of re-rating even higher. Okay, so it's undervalued at 6 times PE, whereas the average peers are trading at about 7.8, and they have superior margins to boot, which are about 5.5%, closer to 6. And if you look at it from an enterprise value basis, and if you assume that 50% of the cash is idle, then actually PEX cash, it's only 4.5 times, so very cheap. We maintain the trading buy with the target price of 43 because the analyst is currently on study leave and is unable to issue a research report update, but he will do so next week when he returns. And the upside risk for target price is quite heavy, so we actually have it on Valuetronics as our strong buy at the moment. Okay, Baostad also released full year results. So revenue was flat. However, core operating profit before exceptionals was up 7.9%, and net profit adjusted for exceptionals was up 3.8%. Okay, so reported net profit fell 13.1%, but this was due to the strong exceptional gains last year. So actually, if you remove all these exceptional one-off gains, core earnings grew 3.8, and on an operating basis, 7.9. Okay, so there's still strong core profitability. Now, it was boosted mainly by energy engineering, which contributes around 27% of profit before tax, which had a record year. Revenue and profit up 49% and 81% respectively. And order books, currently the backlog is about 152 mil versus 181 million the same time last year. Energy engineering has a unique expertise in direct fired heat processors, which cracks natural gas and oil into the elements. We have a good result from water as well, which is now contributing 1%. It had an encouraging year with net profit margins maintained at 6.7%, and the order book is at 50 mil versus 30 last year. And basically, water, as you know, is a highly competitive. Water refining is a highly competitive business. Very hard to make money there. And so it's commendable that they maintain a 6.7% profit margin. And it's basically because the unit has decided to focus almost exclusively on water refining for power stations. And so the requirements there are much higher. Real Estate Solutions had a tough year as they're new entrants now to the design and build. But nonetheless, the industrial property portfolio continues to expand with greater earnings contribution. Okay, so the order book right now for the design and build is 174 million, which is the same as last year. And this year, there was quite significant contribution from the property portfolio, and this also accounted for the improved margins. Now, Geospatial had a strong second half to make up for the weak first half. Sales rebounded after the Aussie elections. ASEAN markets also grew, so we expect the growth for this FY, to continue at about 11%, and so we regard this year the fact that it didn't grow is more of a blip due to the change in the Australian government, and the fact that ASEAN markets have grown, particularly in Indonesia, is very encouraging for the business going forward. Okay, overall order books 380 million versus 1391 million last year. So couple that with Geospatial's growth, the industrial property portfolio is also growing. We expect core earnings to rise 8.4% and 6.4% over the next 2 financial years. As we roll over valuations, the target price is revised higher to $2.40 from $2.05. Bastard we see as a good stock for the portfolio, so it's not the kind of stock where although it's had very good price performance, not one where you buy today and expect it to go up tomorrow. But if you hold it over time, I think you will be rewarded. Okay, property sector.
Hi, I'm Lucas here. Good morning to everyone. Good afternoon, rather. All right. Just some minor corrections here. The date I put here is 2nd of September. I think it's 2nd of June 2014. I'm sorry that I missed that out. All right. Okay, going in, residential will be the first subject I'll be looking at. This is a summary of all the 8 cooling measures. I think I have provided this data to you guys as and when the cooling measures were being phased out over the past few years. So this is a very good summary of what the government has done over the 8 measures that spans over the past 4+ years. So having said that, the last time the government addressed this issue and came up with any policy that was active on the policy front was in February 2014, and that was more of a fine-tuning of the total debt servicing ratio. They actually said that any transaction that is done before that, okay, shall not be subjected to the TDSR rules. Well, I think it's more of fine-tuning. I don't really see as a sign of weakness from the government's stance, but I think that there are other signs that shows the government willing to look at the data, willing to monitor the market more closely, and actually willing to be a bit more relaxed going forward on this front. We shall look at it in the next few slides. All right, this second slide, okay, is kind of trying to double guess what the government are looking at as well. Okay, this is a kind of a property income yield versus the capital gains. We're trying to identify where is the value that investors are drawing their investment from. The green shaded portion represents net property income yield. So it's about anywhere between 2 to 4%, and these are what people actually collect. As in, like when someone actually buy a house and they rent it out, they will get about 2.5 to about 3% income yield on an annual basis. So where are the other gains coming from? Previously, from 2004 to the end of 2007, at the height of the property market, okay, you can see that majority of them actually derive their gains from capital gains. So whatever, look at it from a point of view, the maroon color line, okay, which is year-on-year returns, summarized is a summation of the NPI yield and the capital gain over that year itself. So yeah, we can see that for property in Singapore, the majority of investors just derive their gains from capital gains, derive their returns from capital gains. Sorry. So in the year 2014, in the first quarter of this year, we realized that the price has sort of came down, and as compared to last year, they're actually registering a net loss, even with the property income factored in. So with that in mind, we believe that the government is, we don't think that this is very sustainable, and we think that the government may be a bit more relaxed going forward. Okay, in terms of outlook, this is kind of a summary. 6 months ago, we've actually forecasted that there will be some fine-tuning on the policy front, and right now the government is seemingly going to relax the cooling measures, and they're actually waiting for price to correct further and it become more stabilized before actually making any movement on that. February 14, refined TDSR in terms of their coverage for over the transactions, and they exclude prior sale transaction compared to that date. In May 14th, which is just recently, I think about 1 week ago, MAS, the managing director for MAS actually came out to say that the current situation is unusual, and in the actual quote is that innovative policy measures are not the basis for a new paradigm, saying that the current wave of policy should not be taken as the base case for any future policy. So he said, as in like, we feel that in a way, he's hinting that there may be some further fine-tuning and maybe relaxing of policy on the policy measures. So what about the actual numbers? Is there any telltale signs? For 1Q14, based on new launch and transaction over the new launch is about 1,810 transactions. So this is really a far cry from 1Q13 of 4,600 plus, and obviously in the year before that is about 5,000. So in that sense that we can see that there's actually some weakness. Not say some weakness. There's actually quite a the residential market is really actually correcting already. In terms of capital value, which is indicative of the prices, is about down 6% year on year in 1Q14, and we believe that in 1Q15 you'll see a bigger drop year on year price. So more importantly on the ground, what's happening is that you are starting to see developers from 2 years ago, the launchers, they are unable to sell all their inventory due to the cooling measures. These developers are coming back to the market, and they are actually at the end of their QC. So, well, they're trying to sell their unsold inventory, and some of them are actually putting in a very heavy discount. We're talking about 15 to 20% as compared to their launch price. So, yeah, this is really what is going to happen in the remaining for 2014 as well. A lot of developers who will be forced to sell the unsold inventories to avoid having to top up money or paying the penalty for holding on to the unsold inventories. All right, this is a summary. Just to highlight some of the points. As the property cooling measures started to come on, started to be introduced to the market, you can see that the unit sales and the unit launch, okay, there's kind of a big disparity. The unit launch far outruns the unit sales. So, in this case, the unit sales is only referring to the new launches. So you can see that there's actually quite a bit of unsold inventory that's accumulated ever since 2009. Okay, as in 2009, you can still see that the numbers are still quite kind of similar, but it's only in 2010 second half onwards, you can see that a lot of developers are actually holding on to unsold inventory. So in 2014, the last 3 bars, you can see that unit sales is starting to outpace the unit launch, even in a very weak market. So this is like a negative sign. In other words, what we are saying right now is that developers are being forced to sell at a lower price, and this is actually what is happening in the market right now. So previously, I highlight that there may be some sort of fine-tuning in YH2014 that actually occurred in February 14. I also highlighted the fact that the number of transactions is decreasing and the trend should remain so, and that's also what's happening right now. We do continue to see residential developers showing signs of weakness on this front, which is exactly what has been said in December and January of this year. There is an oversupply. It is evident. This is not really a forecast. Is based on the numbers. Is kind of very obvious. There's an oversupply. It is an oversupply market, and it is still so because there is still a huge pipeline that is there is still a huge amount in the pipeline, and we do not foresee demand actually able to reverse the situation, as in demand was still, well, there is core demand, but yeah, we do not foresee the core demand really matching up to the supply numbers. So we expect numerous launch delays, and cash flow from development projects will be impacted. This is really the case right now. You can see developers really rushing to sell their units at a discount to actually avoid having to pay the penalty. More probable because it just doesn't make sense for them. They're actually incurring a loss if they have to pay any penalty from extension of their sales period. So the last part, okay, affordability issues, which I will highlight later. Okay, it is still the case right now. Why it has not really happened yet, because other major cities are still running high on internal pricing, but we do see that the price of the houses here, as compared to our annual income, okay, is still not measuring up in a more logical manner. So, yep, this is what happened previously. So, what are we expecting in in the second half of 2014? We expect more policy fine tuning. When the numbers are out for 2Q14 for the first half of the year, we expect government to actually take a closer look and actually fine tune the policy measures. But we do not expect drastic change. But having said that, we do advise investors to actually watch out for any lifting of cooling measures, as that maybe if this actually happen, we do expect developer share price to actually shoot quite a fair bit. Yeah, as in that is really kind of a very big trigger point, but we are not really expecting that to happen based on the government's nature of it being a bit progressive on its policy front. The number of transactions has dropped drastically, and we expect this trend to continue in the third and fourth quarter as well. We also expect sales transaction to increase slightly as developers clear inventory at low prices. So ultimately, the number of transaction times the value of transaction, we do expect that number to come down quite a fair bit as well. Residential developers we also do advise clients to actually look for residential developers with well-located projects, and these are the one that will outperform the market. And oversupply situation, it will still be the case for the next 1 to 2 years. And yep, the highlight will be affordability issues. So just to give you guys a flavor of what's on the numbers on the ground, rental value is starting to come down in the 2014 first Q, and we do expect it to drop anywhere between 5 to 10% more for the rest of the year. In terms of capital value, we have seen a pullback. We expect current the 5 to 10, the initial at the start of the year, the prediction of 10 to 15% drop in prices to actually hold true. So we are expecting another 5% downside for residential prices. In terms of stock, what's available in the market is still going to be an ever-increasing function. We do not expect we do not expect the stock to come down. Actually, it has never ever shown sign of it decreasing. This is more of a commonsensical thing. In terms of vacancy rate, here is where we do have some things to highlight. Okay, look at the blue line. Okay, which is the non-landed. These are your apartments, your condos. Okay, the vacancy rate starting to have an uptick. The major reason as to why there's an uptick is because developers are starting to classify their unsold inventory as investment properties, saying that they actually just buy over whatever they have developed, and they hold it, okay, and they lease it out, okay, to individuals out there, and they collect rental income. But due to the fact that there is so many there's quite a bit of unsold inventory, when they first classify, okay, there will definitely be a spike in vacancy rate, and we do not expect the vacancy rate to drop further back to a very good structural level of 6%. We actually do believe that it may have a slight uptick to about 9 to 10%, which is the region of another 1 to 2% increase. Right, in terms of supply trend, as I have highlighted, okay, the amount that is waiting in the pipeline is still a lot. On a year-on-year basis, nothing much has changed. Some have came to the market, but basically this pipeline is continuously being maintained at these levels. And yeah, this situation of having this huge supply will last for the next 1 to 2 years, because yeah, the policy on the policy front is just not favorable for the developers to actually aggressively push out whatever they have in their pipeline, and they are trying to delay it so as to only launch in a favorable market. So in terms of upcoming supply, this is what I predicted at the start of the year. in terms of 2014, 2015, and 2016. And I do believe that these numbers are still intact, and yeah, the supply will largely outstrip the demand. In terms of affordability, this is something that I have to highlight. Previously, we are at about 28. What's 28? 28 is a number of times your annual income. Okay, you have to pay off basically your housing loans, and I'm taking the Singapore average income levels as compared to the typical condo prices. So it's about 28, and this we are relatively high in Singapore. For the left side, okay, India and China is higher because basically their annual wages are lower. So to have a more accurate comparison, we actually compare it to the developed cities, and you can see that Singapore is really much higher than Tokyo, New York, Sydney, and we are just priced below Shanghai, London, and Hong Kong. So in that front, I still believe that unless our prices drop further or annual wages increase, core demand will still face some pressures, and it will still be quite difficult for the average Joe out there, okay, to afford private housing in Singapore. We're talking even for a pairing, like maybe a husband and wife. Yeah, it will still be a very good stretch for them. So affordability will be an issue right here. All right, shall we move on to retail? In terms of the retail outlook, most of it still stays intact. The tourism play is still really strong, and the major challenge right now, okay, is still lies with the retailers to manage their costs. So, by having said that, there's a lot, okay, that of demand right now for our local retail space. We do foresee the landlord still having the upper hand and being able to charge higher rental rates. So, in terms of the numbers, rental value is holding up. There's not much change there. The lack of data beyond before 2011 is because there's a change in the way URA is representing their data. But even after rebasing the rental rate, we can see that the rental value year on year is still at very high levels on a per square meter per month basis. In terms of capital value, we are inching upwards. There's really not much change, but if the current rental value were to hold, we do expect some increase in the capital value based on the fact that the capital value it seems to be a function of the rental value in terms of the net property income divided by cap rate. Yep. In terms of stock, it's largely unchanged. In terms of vacancy rate, we are still at a very healthy level of 7% right now. So really not much issue right now. It's really a case of this subsector behaving in a very resilient manner, and we do believe this subsector will hold up. This is kind of a sweet spot for us. In terms of supply trend, nothing much has really came to the market. If you're looking at the upcoming supply, saying that 2014 and 2015 have a very huge glut coming up. For the most part, I think that there's only 1 to 2 developments that is really new supply. Most of them, okay, is more of previous supply taken off the market and renovating these current malls, and then it's going to come back in 2014 and 2015. And these guys are largely going to be 100% occupied. Pre-commitment level will be very, really high. So I don't see an issue in this subsector. Still a very good and well-performing subsector. This is just a summary of whatever is available that's coming into the market in 2014, 2015, and 2016 and 7. You can see that a lot of them are actually additions or alterations to existing malls, and landlord trying to reinvent themselves. So yeah, I don't really see much of an issue right here. Okay, in terms of hotel, just a quick one. The story still stays. It's still our hot sector. In terms of tourist arrivals and receipts, it's still on track to meet the target that is set up by the Singapore Tourism Board. So, yeah, if there's really a heavy play in this sector and you can see the hotel plays drumming up, I won't be too surprised about it. In terms of office, also once again, it's a quick outlook. Low unemployment is a very strong business environment. I don't really foresee that to change in the foreseeable future. We continue to see big names moving to spaces like Twitter, Nikko Asset Management. They're all moving into the core central area, and yep, there may be a supply lack. As in the next slide, you actually see that the supply is only coming in 2016, 17, and whatnot. But yep, so we will continue to see office rentals going up, and we do foresee the capital value going up as well. This is by far over the past year the subsector that showed the most growth. So rental value will continue to inch upwards. Capital value is on a good uptrend. Vacancy rate is the double-digit vacancy rate is really, I wouldn't really say that there's actually much cause for concern, because it's more of structural. It's more of a it's part of the cycle. Basically, as and when your tenants move in and move out, you have to give some discount to the incoming tenants, and therefore the effective vacancy rate is double-digit. But yeah, well, for the most part, the concentrated area is going to be perform really well. Most of the buildings will be like full occupancy. All right. Quickly, supply trend still stays, but a lot of them is coming in 1.5 and 1.7. And in terms of I'm so sorry, the retail sales is it should be dropped, right, in this diagram. Okay. Recommendations wise, we do not for the whole real estate sector, we do not see any bottoming out. We also do not foresee any bull run. So we would rather investors focus on growth stocks, stock that show actually prominent growth stories, and actually trying to ramp up their operations and investment and development projects. So we advise to focus on prime retail and prime office, and also hospitality subsectors. All right. Just as a bonus add-on, okay, covering on CDL. Previously we did I initiated it some time ago, so this is just an update. Okay, the base case still stays. In this time around, after the earnings and based on what's happening in the market, I actually put down the valuation for residential a fair bit, and actually valued their residential projects slightly lower. But having said that, well, in the most recent land bid, okay, you can see that they are still actively looking out for land spaces that makes sense. Basically, they actually won the bid at $330 per square feet at the Yishun land for executive condominium. So yeah, I do not really see much weakness for CDL in the residential space, but this is the base case. So yep, we do derive a total gross asset value on about $18, RNAV of 16, and a target price of about 11.26, which will represent about a 9 to 10% premium compared to current day share price. And having said that, there is still much further upside from the fact, the first key point, if there's a stabilized residential market for them, we do foresee that their residential for Singapore will actually perform better, and therefore the target price will be raised to 11.61. Another potential upside for this is actually the fact that they have a very strong balance sheet. They do have a huge load of cash on hand, and on top of that, their net gearing is really kind of low at maybe low 20%, 20+%. So they do have quite a huge amount of debt headroom. Coupled with the cash, they actually do have the war chest available to actually embark on many other additional value accretive projects overseas. And that was what Mr. Grant Kelly, their new CEO from last quarter, is hired to do. So we do foresee that in the next half of the year, as he start to run through all the different projects, potential projects, and opportunities, okay, that such new deals will come to the market, will be shared with the market. So as and when that happens, okay, we do believe that will actually be a key trigger for the share price to move upwards. So if that will be the case, we actually have a target price on 11.85 based on whatever we actually, in our estimation, we actually look into the potential returns from overseas projects, especially in the Europe and other North Asia. On top of that, also in terms of in the US and also in Australia, and what are the returns like, and we just based on those returns, we try to estimate what type of value they can unlock with whatever cash and available debt headroom that they have, and that's how we arrive at our target price. And the third upside will actually be an increase in office rental. This will actually be much muted because most of their buildings are fully occupied. So even if the uptick is in terms of valuation, and that will only bring, but it is still a positive point. And I do have to factor that into this scenario. But yep, this is also a potential upside for this company. All right. So as a summary, in terms of investment merits, firstly is an undemanding valuation. CDL basically do not include revaluation gains into their books. So yep, although it seems to be that they're trading at about 1.5, 1.6 times their book value, in actual fact, if they were to factor in revaluation gains as per like other companies, they're actually trading at a very heavy discount of maybe like 70-80% as compared to book value. So this is where we believe that this valuation upsides. The potential stabilization of residential sector, their strong balance sheet, and also the potential increase in office rental rates will be the three key factors that they may impact their share price positively. And obviously there may be some policy tightening, which is right now we do see that this is more of a no longer really that big an issue. Or maybe the another risk will be the weak hospitality sector in terms of the global hospitality sector. We do not foresee that actually happening because CDL have quite a good spread of their hotels around the world through Millennium and Compton. So in that sense, an underperformance in one sector will usually bring about will normally be met with something that will cancel it out, or maybe a positive performance in maybe another geographic region, unless there's a global financial crisis or something that's really that huge, that something negative that happened on a very huge scale. So yeah, in terms of the risk, we feel that it's kind of quite muted. So once again, the base case, we do have on our base case, we do have a target price of 11.26, and we do see further upside for this counter. And with that, I came to the end of the presentation. Is there any question? Do post it to us.
There's some question actually say other than CDL, other stocks and company do you recommend for office sector, and do you have any recommended stocks in the hospitality sector? Okay, for sector, we actually also recommend on OUE. Currently, it's pretty undervalued, although it has rallied a bit last week. But from what we see, there is still potential growth for OUE on this because at the moment, they are having a net cash of about 800 over mil. And for the hospitality sector, we actually would recommend Amara, which is also one of our top picks since last year. This year, they are actually, as we have, if you read our report, we actually have mentioned that the Amara Bangkok will be ready for this year. So we expect to see more contribution from the Amara Bangkok on starting from the second half of this year, and from 2016 the Amara Shanghai will also be ready for contribution. So from what we see, these two actually have good potential for further growth.
Hi. Additionally, if let's say you guys are really looking for a hospitality sector and you guys want to as in like maybe hospitality retail sector, I do recommend Croatia's Retail Trust, which was previously I did initiate on it and actually sent a report out. I do recognize that there's a fair amount of increase in the share price already. However, I think that there's further upside. And in June, when they actually announced their distribution, okay, we realized that basically the dividend yield for over the past FY14, based on the current share price of 96-97 cents, will actually be about like 10%, 9 plus 10%. And yep, definitely we do see very strong upside for Croatia's Retail Trust. Okay, another question for CDL. What are the macro risks do you foresee? Thailand and Ukraine. I wouldn't really say that specific to Thailand and Ukraine where that will actually form the source of a major macro risk for CDL. CDL is still have a stronger proxy in Singapore residential real estate, and in terms of their hotel valuation, will actually basically to look at it in a more sector-wise basis first. Okay, largely their gross asset value will come from Singapore residential, hotels in terms of the global hotels through Millennium and Compton, and also Singapore office and Singapore retail. So macro the macro risk that we foresee, okay, is those that will positively or rather negatively impact Singapore front, which are really kind of like some policy risks, business environment risks, that is really going to like basically heavily impact this sector, like the resi in Singapore, the office in Singapore, and also the retail in Singapore. Yeah, that is the type of macro risk we are talking about. But maybe other countries becoming cheaper to having a more favorable business environment to operate in, and we see a Singapore office moving out to there. Yeah. So those are the things that we're actually looking out for. Not so much of actual political upheaval in Thailand and also the war zone in Ukraine. So yeah, hope that answers your question.
Good morning, Benjamin here, your financials analyst. There's a question here on when will banks raise mortgage rates and what's the impact on affordability and bad debt. Okay, so currently in terms of mortgage rates, I think the near future, near term wise, we don't see that the banks will actually raise mortgage rates as there's quite a lot of competition now in the mortgage market in terms of seeking as well as competing for the refinancing portion, where most home buyers will want to lock in the fixed interest rates now to take advantage of the low interest rate environment. So, but typically, on a longer term basis, usually the mortgage rate is fixed at a SIBOR rate plus a certain spread. So we see that SIBOR probably start to move up only in 2015 onwards. That's probably when we'll see the mortgage rates actually going up. So bad debt wise, most of the loan book for the property side for the banks are mostly about 90+% are actually homeowners. So in terms of bad debt wise, we don't see much of a problem even if the mortgage rates do normalize. Bad debt for owner typically linked to unemployment rates in the country rather than the actual increase in interest rates that will result in bad debt. So I hope that answers your question for that.
Hi, there's a question that goes, in the case of property cooling measures fine-tuning, what are the possible measures that the government is likely to take, like adjusting TDSR or stamp duties or others? I can't really say that as in on this policy front, it's really how innovative our policy formulating part of the government is, how creative they can get. So I can't really say that there is really a market. There's anyone in the market really wanting to predict what are possible measures that they can take, because it's really kind of like it's very free running on that front. But what we can do, okay, is to actually look at the effective what's going to be the outcome of it, like maybe how will it impact your share price, whether it will be rebates. Okay, we do rebates to the buyers, or will it impact the sellers. We can look at the net effects of these policies, and in this time around, we do believe that if they were to really want to adjust it, it's ready to adjust it for the core demand and the core buyers. This is where the government is trying to position themselves. They want the market to be favorable to people who actually genuinely want to buy and stay in it. And therefore, yeah, we do believe that there may be some like discount to the actual core buyers, or making lending rate available, as in allowing them to have stronger borrowing ability from the banks and whatnot. So that would be the net effect. It's largely targeted at giving the core buyers a better chance at affording these units. So as in, I hope that answers your question, because there's really no way that anyone can predict the actual policy that the government is going to take or introduce in the market. Yep. All right. The next question, for Singapore residential property, what is the sustainable and affordable price in terms of per square feet instead of number of years of salary? Okay. I shall try to answer this question. Firstly, to to quantify, why do I actually look at it in a number of years of salaries? Because I mean, it kind of have to be a balance. There's no fixed one number quantum whereby I can say that, oh, at 1,000 per square feet, it's going to be affordable for everyone. I mean, it has to be a rate, like the price of a house as compared to years of salary, or the price of a house as compared to something else, another price of food or whatsoever. So it has to be a measurement. So when it comes to affordability, that's why I use a number of the annual salary and the quantum numbers, and that will also be easily identifiable by investors as well, saying that the number of years that you take to pay off a property loan. Yeah, so in that way that these two numbers kind of match quite closely. But having said that, I would like to answer your question. Okay, what based on current, let's say the salary right now, okay, what is affordable price in terms of PSF? Let's just assume that the salary right now will not change over the next foreseeable future. So what will be the affordable price will range anywhere between about, instead of maybe 1,000 to 1,003 per square feet, I would say that per square feet basis, you have to drop to about 800 plus 900 for it to be affordable, truly affordable, as compared to all the developed cities around the world, not just the top developed cities around the world. You had to drop to about 860 to about 910, this range, to actually be comparable to the rest. But having said that, this is really making a very broad assumption that your annual salary do not change at all. So that's why I was saying that if your salary, the annual salary or the average salary across Singapore were to increase, then that will work as well, isn't it? So when do you think, the second part of the question goes, when do you think the price will be realized in the near future? I do not think that this like $900 per square feet for the condos will actually be realized in the near future. It really depends on where the property is located and where you're looking for. If I would say that, it will take me, I would rather think that the salary will actually increase to match for Singapore to solve the affordability issues. Yeah.
Hi, question on SingPost. We don't have coverage on SingPost at the moment, but I think we can give some opinion on it. Okay, so the placement is dilutive, and as yet there are, I think the plans on how Alibaba and SingPost plan to synergize is not yet announced, but one can imagine that perhaps Alibaba might start pushing volume through SingPost. On that note, I think the outlook for SingPost is positive. Now, technically, it's gapped up a lot, and it's starting to close the gap. So you could look at 155 as a re-entry point for the moment. Thanks.
Question: if Singapore property affordability is 28 times annual salary, what is generally the ratio in Hong Kong, Tokyo, New York, London, Sydney? I think this is actually available in one of the slides, which is actually on your screen right now. For Hong Kong, okay, is actually much higher at about 41, 42. For Tokyo, New York, okay, is actually much lower, maybe at 21, about 23 times for New York, and about slightly less than 20, or maybe slightly above 20 for Tokyo. Yeah, I hope that based on the image on the screen right now, that actually answers your question. Yep, and for a large part, okay, those cities that is really, really high in terms of number of times the annual salary is more of the fact that their annual salary is lower than Singapore itself. Yeah, I would, as in like, except for maybe Hong Kong and Shanghai, because they are really the runaway property bubble that the government is really actively trying to pull back. Yep. There's a next question. What is the rental yield for the year 2015 to 2017? And also, is there a supply issue from 2016? Yep. For a large part, okay, the rental yield right now, okay, is about anywhere between 2.5 to 3.5% for residential rental yield. this is really, really low as compared to any other cities besides Hong Kong and Shanghai, definitely. Yeah, our rental yield is really low. Australia's residential rental yield will range about between 5 to 6%. And is there really a ideal yield or a market average per se? I wouldn't really say that there is really a scientific or mathematic way of coming up to that number. But for the most part, other countries, okay, normally will come up anywhere between 5 to 7% in terms of residential rental yield. And I believe that is where investors are also more comfortable with such returns. You do just give them an additional 2 to 3% margin for safety, and also 6%. Yeah, it only means that you still need about 10 to 15 years, okay, for you to of rental use to collect back the cost of a property, not including the fact that you have to pay for a lot of expenses that is spent on the property itself. So, but it just seems that right now across the world, 5 to 7% is where a lot of investors are actually more they feel comfortable with this level of rental yield returns. Yep. And you're saying that what about the supply issue from 2016? For the most part, even by 2016, I do not foresee the supply issue actually totally clearing off. The government is still very actively putting out the land. The supply pipeline is really, really huge. And yeah, I still believe that there will be an oversupply issue unless really someone somewhere have to get hurt from this oversupply. The developers, the buyers, or basically the government. So someone had to absorb it, and if not, okay, if everything were to be play out in an efficient, if the market is truly efficient, is that this supply issue will really hang on for a while, and it will slowly dissipate over the course of maybe 3 to 5 years, whereby the market is given time to absorb it slowly, and then it will ease off. If not, even in 2016, I do not really foresee a supply issue totally, as in the oversupply situation totally easing off. Hope that answers your question. No more? Get it? Alright, we have come to the end of today's presentation. I thank you all for your time, tune in, and I hope to see you guys around next week.